Good morning to all of you, and warm welcome to the YourNest Investor Day. I'm so privileged to have Bejul for this insightful interaction that I'm looking forward to for the next half an hour. Challenge in here. The biggest challenge is being an entrepreneur. And I want to start with asking Bejul, if you had the option to be an entrepreneur, you would have loved to be an entrepreneur, or you still chose to be a venture capitalist?
Morning, Sunil, and thank you for inviting me, and morning, everyone. I chose to be an entrepreneur. I am an entrepreneur.
That's good.
I'm an entrepreneur in the venture capital business. What I mean to say is that we are building a firm the same way entrepreneurs build firms. We have to think about our proposition. We have to think about our differentiation. We have to think about our organization.
Yeah.
We have to think about attracting the best talent. We have to think about delivering returns to our stakeholders. We have to think about culture and performance. So I've generally been a builder in my life. In this case, I'm a builder in the investment business, but I do, and I think our culture is one in which we think of ourselves as entrepreneurs.
Fabulous. He's just resonated the feeling that I and Sanjay, when we conceptualize that this is a good enough challenge. Even being a venture capitalist, you're more like an entrepreneur. Thank you so much. Bejul, Lightspeed is a very prominent top-tier fund from US. Recognitions have been coming by time and again for Ravi and your partners. You have offices in Israel and China. And still in 2006, you started to invest in India. And then later, 2015, you launched an India dedicated fund. What's bringing to India?
In 2011, we were wondering that because it had been 5 years. I think there was a question on when will we see money. And we'd been in the market 5 years, and I think that was a point at which actually many US venture firms exited the market, 2011, 2013, at precisely the wrong time. And that really is so important in our business, right, is you have to have long-term conviction. When we came into India, the reason we came into India was that it was clear to us that the digital economy in this country would get built.
Yeah.
And when digital economies get built, there is significant upheaval, there is significant value creation. And there is significant transformation. And we wanted to be a part of that. Now, we had thoughts on when it would happen and the time frames in which it would happen. In the event, it took longer.
Yeah.
But the conviction that it would happen and that when it happens, there will be significant value creation and transformation. That was, I mean, we had that conviction throughout the period.
Yeah.
Right? And so that's what led us through that phase of, let's say, 2011, 2013, where many investors who had begun investing in India in 2005, 2006 were asking these questions, right? What we began to see in 2014, Sunil, was, you know, India is often, it's very seductive when you look at it top down. There's a billion people, everything is underpenetrated, there's opportunity everywhere. Right? As we all know, it's not that simple. And so we tend to be very focused on bottoms up as well. And in 2014, we began to see things change in companies. We began to see the entrepreneur profile changing. We began to see more bold, provocative entrepreneurs. We began to see more risk capital flowing into the market. We saw growth rates inflecting, right? And so that was a time when we felt now we didn't want to try and time the market anymore. We, in a sense, wanted to double down, which is why the firm raised an independent vehicle for India.
So good. Very, very important point you made out here. I want to drill down deeper. From the founder's point of view, 2011, many such international VC funds walked away from India. And that's the time you took a decision to stay on. How many investments you would have made until then?
I think at that point, perhaps 3 or 4. So we could easily have sort of said this was an interesting experiment. Let's go back and invest in the Snapchats of the world.
2006 to 2011, just...
Yeah, 2007 we made our first investment, so we made about one investment a year in that time frame.
Look at less is more. At YourNest, we invest hardly 3 to 4 companies in a year, and that's how we've been nurturing. And that lesson came in from Bejul and his co-partners, his fellow members at that point in time, who continuously kept telling us, it is not about market share of investments. It is about market share of returns. So focus not on multiple number of companies that you're investing in, but what you're building to be able to return.
I remember in 2011, a Mint reporter reached out to me saying, last month we did an article on the most active venture firms. And this month we're writing an article on the least active venture firms, and we wanted to speak to you. And I expressed that my view that this is not a market share business.
Yeah. Very well, very well. Since you chose India, you have, what pushes you to choose the sectors that you want to invest in? What is your outlook on sectors? And lately, despite being in Israel and US and Silicon Valley, you've started investing in B2B and tech-led ventures here too. Miss, what's the thesis behind that?
So first, let me correct the perception. In 2010, we invested in a company called the Indian Energy Exchange.
Oh yes, correct.
Which operated an electronic market for power, which even today I'm sure people will find that idea in India that you can trade power electronically. You'll probably be surprised. We made this investment in 2010. Yes. It was a B2B company, and the company, after raising, we invested 35 crores. The company never raised another cent of primary capital, and went public in late 2017 or 18, I don't quite remember, at a 5,000 crore valuation. That's why we like B2B. I think you spoke about capital efficiency. Certainly these kinds of businesses can be more capital efficient. I think consumer in India it's exciting, and it's what we read about in the newspapers, but it's very tough, and it is incredibly capital intensive. Now, we're in consumer businesses too, so for us, there is a way that we invest in consumer that'll be different than the way we invest in enterprise. More recently, we're drawn to B2B, not necessarily because we're saying we must do B2B, but if I can talk about what we look for in companies, and therefore what we find in some of these B2B companies. So we're interested in being involved with helping to build truly impactful companies. And if you want to do that, then it starts with finding very talented people who are deeply connected to problems in very large markets. Now, I'm not going to say anything that isn't 101. I have really nothing to offer that you haven't heard or read. Yeah. But we see so many people actually target interesting problems in very small markets. That will be the first step to constraining the opportunity. So we really focus on the scale of the market. Then we focus on why now. This is a question we debate intensely in our firm. Why now? Because if you're a startup, the world is against you. You are not meant to succeed. People do not want to join you. Customers do not want to buy from you. Wow. People don't want to give you money. Right? The deck is stacked against you. So there has to be a tailwind. There certainly can't be a headwind. So large market, strong tailwind, most important, the people. Companies are nothing but collections of people. And when we think about people, we've now, we've isolated what we look for in people. Often, when we look for people that are deeply connected to their markets, that doesn't mean they need to be insiders in their markets. In fact, often the perspective comes from outsiders, but yet who are very deeply connected. They see things in a way that sometimes insiders don't see. And then finally, at least, thoughts around a business model architecture that can really capture the value. Right? How many times do we see two companies addressing the same industry that might look similar, one company is worth 3 times the other company. Right? Why is that? And it's often to do with the mechanics and the dynamics of the business model and the approaches, whether a company, for example, has network effects, what the capital efficiency profile might be, what the barriers might be, whether they can extract a premium, those kinds of issues.
Very well. You touched on the, the micro element, the bottom up, from a people point of view. You know, the things that you look at it. Do you think the first-time entrepreneurs, largely we end up investing, they have the ability to build a unicorn? And if yes, how do you see that? Means can they build really great, strong companies?
So first, let me, I feel that you asked 2 different questions, because you asked if they can build unicorns, and you asked if they could build fundamentally strong companies.
Yes.
Unfortunately, today, I don't think those 2 are equated. And I think it's a concern, and we can have a much longer discussion about it.
Correct.
And I think 2020 hopefully will cause some realignment. Okay. Can they build, now that said, can they build unicorns? Yes, they can. Can they build fundamentally strong companies? I believe they can as well. Okay. But to do the latter will require significant company building capability and, I like your word, nurturing.
Yes.
That surrounds these entrepreneurs. We call it sometimes, we'll call it company building, we'll call it guide rails.
Yeah.
Right? And the reason I use those words is because what some of these first-time entrepreneurs have is they have passion, they have belief, they have a naivety, and they have a fearlessness, which I believe is incredible raw material and fuel to build something big.
Yeah.
I think that without some of those qualities, you may build a business, but you may not build a truly disruptive business. But the issue is that they also don't have a lot of things.
Yeah.
Right? But our view is that if they have those things, that is foundational, that is raw material. It's very hard to hire people with those things.
Yeah.
Right? Which is why entrepreneurs are entrepreneurs. Yeah. They're not hireable. And then it's our job to surround them and help them build these other capabilities, to help them recruit, to help them see what they need to recruit, to help them attract the kind of talent that they're going to need, to help them see around corners and recognize that a year from now I'm going to need this person. So I should start looking for that person maybe 3 months from now. To think about milestoning, I think one of the big mistakes we see first-time entrepreneurs make is they focus on the wrong things. And then by the time they need capital, they haven't proven what investors need them to have proven. Some companies scale prematurely, one of the leading causes of death. I think we'll see more of it, right? So that's why we call some of these things guide rails or company building. But if we can combine this raw material and this incredible energy and connection to the market and capability, right, with then the benefit of experience, let's call it. In my mind, that's sort of how we get some of these first-time entrepreneurs to build both high-value companies and fundamentally strong companies.
Absolutely, well said. Now here, there is a process that we VCs follow to engage with the entrepreneur. Sometimes in the early stages of investment, a fortnightly review or a monthly review, and then the board meetings for some strategic interventions, etc. I heard from Ritesh Agarwal's one interview that you were taking on with him a monthly lunch meeting. How's that informal monthly lunch meeting more valuable than a structured monthly review with the team?
Well, that wasn't the only thing that was happening. That was in addition to all of the other things. So look, there were periods of time when I spent, I think, a third of my time recruiting for the company.
A third of your time for recruiting?
So we helped hire Abhinav, who's the COO. We helped hire Abhishek, who's the CFO. We helped hire his head of public policy. Unfortunately, one of my colleagues joined as chief strategy officer, so I guess we helped hire that too.
You gave a good resource to him.
So there was a lot involved there. The second thing is, I would say, a lot of, as you say, sort of more structured working sessions. Yeah. But the reason I did and do these, call it monthly lunches that are less structured, is for two reasons. One is, I think you can then go off script. Yeah. And when you go off script, you learn a lot as an investor. But I think you can also engage on longer range issues. Mm-hmm. You can engage around investments that we maybe need to think about making now that may not come when you're doing structured working sessions focused on the very near term. I think you can really get into the mind of the entrepreneur. Yeah. You can really understand what this person is thinking. And often for me, what motivates them, what's happening in their personal life. Ah. You know, I think it's so easy for us to always just think it's all about work. Never. Obviously it is, but at least I'm very interested in understanding people. You know, when we invest as early as we do and we talk about investing in people, then what does it mean to understand that person, right? And that's where a lot of that comes for me. What keeps that person up at night? What else is happening that he or she is thinking about? And, you know, what I didn't realize at the time, but I realize now, is it's helped me. It's those sessions are where I've built trust with the entrepreneurs. And I think trust then becomes a currency that enables us to influence and accomplish things in a company that we might not otherwise be able to do.
Very, very well said. How do you manage your time if you end up doing so much for the startups? I would like my partners to get to hear, how do you manage your time for doing all this?
And with so many lunches, how do you manage your fitness?
Unfortunately, I don't think I'm as fit as I would like to be. I don't think I spend as much time with my family as I would like to. And I perhaps don't sleep as much as I would like to. But I get so much back from the work that I do that it doesn't feel like work. And that's both wonderful and a problem. Because then it, in a sense, pervades all parts of my life. I don't think I manage my time very well. But I do think that I keep trying to make sure that I'm focused on the most important things. It's so easy to get into the weeds. And when we get into the weeds, we actually often lose sight of what really matters. And so, you know, what I try and do is I try and allocate my time to where I think it has the highest impact.
While I was interacting with him for this session, you used a very wonderful term. You know, you focus on needle-moving action plans. How do you go about identifying those needle-moving this thing, and how do you, you know, in a way, get the focus on the top item? Sometimes quarterly, we tell the entrepreneur, only one thing, retention is your objective. Nothing else, you know. I'm not looking forward to new acquisitions. I'm not looking forward to go after one thing and make that happen. If that happens, you will get the new customers. Or in one company, we went about talking about that just get US customers in the next 3 months, US clients, and you're done. What are those needle-moving items that you focus on?
Can I do a quick thought experiment?
Yeah.
Can I ask the audience, can you put your hand up? How many of you know what you're going to do today? I hope a lot of hands go up. Keep them up, please. Keep them up. How many of you know what you're going to do today? Okay, so 90% of us. Okay? Keep your hands up. Please keep your hand. Now, how many of you, keep the hands up, how many of you ask yourself, am I the best father I can be? And if not, what can I do to be the best father? Hands can start coming down as these go. How many of you ask yourself, am I the best husband or wife that I can be? And what can I do to be the best husband or wife? How many of you ask yourself, am I looking after what are the most important things in my life? And am I paying attention to them and investing in them as much as I should? And now we've gone from 80% to about 5%. It's the same thing. We just have to ask ourselves, and we have to ask each other, the most important questions. And when we ask those questions, we identify the most important things. And when we identify the most important things, we spend time on the most important things. But the problem is that so often we are running around, focused on the short term, in the weeds, that we don't step back. And we don't ask ourselves these questions, and we therefore don't see what we might otherwise see. So that's how we think about identifying these, what we call these needle-moving things, and every now and then we succeed, and very often, we don't.
Let me come to the last part of my thing, which is the completing the cycle of venture capital. We investors are in the founder's journey for a short period of time. The founder is there for lifetime. We are there to exit. You've seen the exits. How do you go about convincing the founder that this is the right time for you to exit? What is that mechanism? Can you give some anecdotes, some experiences here, which are important because many of our entrepreneurs will be going through this challenge in the coming years?
Okay, I'm going to say something quite controversial, especially in a room full of investors. We don't think that we're here to exit.
Wow.
We think that we're here to build great companies. And that if we build great companies, exits will happen. And that has generally been our experience.
Okay.
So that then also, if we have that mindset, then that also eliminates the asymmetry between the investor and the entrepreneur.
Yeah, correct.
Where the entrepreneur is here for life and we are here to make a buck.
Yeah.
Right? Because we are aligned. We are aligned in our mission to build a special company.
Yeah.
Right?
Correct.
And so if I take Indian Energy, and then an exit opportunity presents itself as being on that path. Right? So, when we took Indian Energy Exchange public, it was an initial public offering. The company didn't need money.
Yeah.
The company was generating about 100 crores of cash a year. But we engaged in a discussion around the fact that now this is a milestone. And the board had been a private company board for about 7, 8 years. We could infuse fresh thinking as we think about where the company needs to go now. What serves that mission? Right? And it was a conversation that ultimately led to an offering that was entirely 100% offer for sale. It was all investor liquidity.
Wow.
Right? More recently, and I don't comment too much on it, but as you know, there's been a liquidity event at Oyo.
Yes.
That wasn't something that we were, necessarily engaged in talking about.
Oh, yeah.
It was something that came up in the context of how is the company going to be capitalized in the future. And, different visions for how the company should be grown. And in that set of conversations, this emerged. So I would just say that we're really focused on building strong companies, and if we do that, we do believe that exits will happen. It's not to say we don't think about them. It's not to say we don't plan for them. Obviously we do. But I think just thinking this way, it eliminates the idea that us and entrepreneurs may be solving for different things.
Wonderful. In both the cases, the founders wanted to keep their stake, rather enhance their stake in the companies. That's the kind of belief they had. So good companies always find the right partners on the path.